Welcome to GK FinTalks, a destination for success. Today we will discuss about ratio and analysis. This is very much useful for analyzing balance sheet and other financials of a company or a firm. Friends, today under this important session ratio analysis part 1, we are going through liquidity ratios. Liquidity ratio is very much useful for knowing firm ability to meet short-term obligations. There are so many ratios, out of which liquidity ratio, leverage ratio, activity ratio, profitability ratio are some of the ratios to analyze balance sheet and other financials. Now first we will see and discuss about liquidity ratio. Some of the important liquidity ratios are current ratio, quick ratio, or acid test ratio, or cash ratio. Now we will go one by one. The first one is current ratio. This is expressed in terms of times to current assets to current liabilities. Normally, it is treated as ideal that 2 is to 1 is the best ratio. But in Indian conditions, the ideal ratio is 1.33 to current ratio to 1 current liabilities, and it is acceptable to banks also. Current ratio means current assets divided by current liabilities, and this ratio is different for different activities. For example, for trading activities, the acceptable ratio is 1.20 is to 1, and for seasonal industries, it is 1 is to 1. For non-banking finance companies, microfinance institutions, export-oriented units, textiles, rice mills, like that, it is 1.11 is to 1 is acceptable. If the current ratio is less than 1, then it is a symptom of sick, and the firm is going to face lot of problems in meeting its short-term obligations. To get a better and clear picture, if any slow moving goods are there, that should be segregated, they should be segregated separately, and they should arrive current assets. Otherwise, the current ratio which is generated through this give a wrong picture about the firm. Current assets means it should be less than 12 months. Some of the current assets we will see: cash and bank balance, short-term investment including bank deposits, receivables or book debts derived from the sales, stock which includes raw material, stock in process and finished goods. All these will come under current assets. Now we will see some of the current liabilities which will fall due under less than 12 months. Bank overdraft, cash credits, advance against book debts, bills discounted, deposits from public which is going to mature within 1 year, accrued interest, salaries, wages, administrative expenses, gratuity, insurance, etc., and other statutory expenses like taxes and any other short-term commitments will come under current liabilities. Till now we have gone through current assets, current liabilities and current ratio. These things are very much important for assessing working capital. Now we will start analyzing acid test ratio and quick ratio. Normally for acid test ratio 1 is acceptable as ideal, and we will see some of the assets which can be taken for acid test ratio. Acid easily convertible to cash only taken for consideration. Inventory will not be taken as it makes time to convert into cash. Quick assets, cash, bank and receivables up to 6 months will be taken. Bank deposits, government securities, shares, etc. will be considered. And now we will see current assets minus current inventory divided by current liabilities is one of the formula. Likewise, cash, receivables, investments divided by current liabilities is another formula. Both one and the same, and which is useful for deriving acid test ratio or quick ratio. Another important ratio in liquidity ratio is cash ratio. This also shows firm's liquidity. The formula is cash plus marketable securities by current liabilities. Cash ratio is equal to cash plus marketable securities by current liabilities. That means the assets which are easily convertible to cash can be taken. Friends, now we will see as a final this one all the three ratios at a glance. That is current ratio, acid test ratio and cash ratio. Current ratio is equal to current assets divided by current liabilities. And current assets, current liabilities already we have gone through. Acid test ratio or quick ratio, current assets minus inventory by current liabilities. Another formula is cash plus receivables plus investments divided by current liabilities. And cash ratio is cash plus marketable securities divided by current liabilities.